Now starting. All attendees are in listen-only mode.
Hello, ladies and gentlemen. I apologize for the delay. It looks like Kurt was having some sound problems, so I had to switch over, take control back of the screen here, and get us started here before Kurt can launch in. Welcome to today's presentation. My name is Mike Chupka. I'm the Director of Education here at Power Options. For those of you that don't know, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. We support over 23 different strategies. I've been with the company for about 10 years, and about 4.5 years ago or so, I was handling a coaching session for one of our free trial members. Our free trial members, of course, can sign up for free coaching sessions, as can our subscribers. And during the free coaching session, the customer wanted to see how to use our historical suite of tools to identify married put positions, of course, but done in a unique way. And when I first saw the setup, I showed the customer how he could identify these positions, but I told him honestly that I don't know how you're going to make money with this setup. It looks like you're investing a fair amount into the position in the sense that you're buying a put option that's not normally purchased, and then because you're adding so much cost in the position, I don't see how you're going to make money. Well, the customer introduced himself as Kurt, of course, Kurt Frankenberg, who will be joining us in a few moments. And he invited me to his free webinar, much as you're doing today, so he's going to show me exactly how he makes money with these positions. So I was so impressed with the first presentation that I saw back in 2007 there, that I invited Ernie to join me for the next session Kurt was having, and Ernie was so impressed, Ernie, the president and founder of Power Options, that we decided to partner up with Kurt and enhance the Power Options tools in the Married Put menu to work with Kurt's technique and also enhance our portfolio tools. Now, on a more important note, since I've seen how this works, I've been trading the radioactive techniques with about 45 to 55% of my portfolio for the past 4 years. And everyone asks, well, are you happy with your results? And my answer is, well, I wouldn't still be trading it if I wasn't happy with my results. I've started out, as many of you did, doing covered calls for the first 1.5 years, and I realized that I wasn't getting ahead. I'd make 2 or 3% over the first few months, and then I'd end up losing and giving it all back to the market in the 4th month. So it'd be right back where I was after 4 months of efforts, and go forward another couple of months there, and then end up giving it back. And I tried other strategies such as calendar spreads, iron condors, and in the past 4.5 years, I've been more successful with the radioactive trading techniques than I have with any other strategy that I've traded as well. Sounds like Kurt is with us. Is that correct?
Yes, I am. Finally, boy, I tell you what, sorry about that, ladies and gents. I had some difficulty with sound, and trying to solve that difficulty, I finally went to a backup. So anyway, we're on. And, Mike, what have I missed?
Nothing. I just gave my introduction, sir, so you might want to introduce yourself. I went through our full introduction about how we met, but you might want to give some background to yourself there, and then we can get to know who's with us today in the audience.
Okay, very good. Well, just a real quick introduction of me. I own a martial arts studio. I have since 1986, and that's my first love, and it's what I continue to do to this day. But along the way, my studio became successful enough that I needed to put some money into investments, and started out with real estate. Didn't do real well at that. I mean, I made some money, but it just seemed like a lot of work and a lot of stuff you had to know, and a lot of steps that you had to take, and tenants you had to deal with, things like that. It just wasn't me. But I went to a seminar, a weekend seminar that was being held by a guy whose name was very respected in the real estate investing community, and he had started teaching about the stock market and options plays. And, of course, that was, gosh, back in 1998, 1999. I went to Zero to Zillions was the name of the weekend course, and learned about covered calls and calendar calls and bull call spreads and things like that. And I started making money, started doing really well in it. And it seemed like a really low maintenance, real easy, clean way to invest. But then you know what happened next.
Right.
I was just following directions. You know, I was picking stocks that were priced between $5 and $20. I was selling front month calls, and I was doing it on margin, and ended up getting killed. You know, got into a company that had really good premiums, and found out that the reason for high premiums is high volatility. You know, a lot of uncertainty. And anyway, looked like I was going to make a killing, and instead I got killed. And that was back in 1999-ish, 1998, 1999. And it was a while before I could put some capital together to trade again, but I decided I was going to do it a whole different way. And I spent a lot of time studying the lives of great traders and what they had in common. They had almost nothing in common, as far as what they would invest, what would tip them off to get in, you know, what entry signals, what exit signals. Some of them didn't even want to exit, like Warren Buffett. He never wanted to exit. And gosh, I found out that they had almost nothing in common except for one thing, and decided to emulate that one thing and design a system around it. So now that one thing is rule number one: don't lose, or don't lose too much when you can lose. Okay. So Mike, let's get our folks introduced here. I'm going to ask just a real quick poll here. What kind of options plays? What kind of options trading are you doing right now? And if you're not trading options at all now, that's fine. We're going to take things at a pretty steady pace, although there's going to be some stuff here that even our advanced players are going to say, wow, you know, I hadn't thought of that. Okay, folks that maybe have done options trading for a while, you might think, well, geez, you know, I hadn't thought that you could do that, but that does sound good. That sounds right. And we're going to be able to serve the folks that have had no options background, but we're going to also be able to serve folks that have had quite a bit of options background. And I know that sounds like a conundrum, but we're going to be able to do it today. So let's give it about another 10 seconds here, Mike. We're neck and neck, covered calls and long calls, or long puts, or naked puts. You know, those first two columns are tied. And not a lot of folks doing spread trading, which is interesting. But we do have some folks saying that they're not trading options at all, and that's cool. Okay. Remember, there was a time when you didn't know what a stock was. So, very good. Okay, let me go ahead and put that up there. We finally did break the tie. There's 52% doing put calls, 56% doing long calls or puts, 36% doing spread trades, which we're going to be showing some really interesting spreads today, and 20% not trading options at all. Okay. Now, here's the deal. All I want to know is, how happy are you now? How happy are you with the last 12 months? Okay? With the last 12 months of your trading, you know, it looks like a lot of folks, more than half, are still doing the tired old strategy of covered calls trading. And so what were they promised, Mike?
Yeah.
100% a day, or 200% a second, or what's the normal promise that's given to?
I actually had a long conversation, a good hour and 15-minute conversation yesterday with a gentleman who was inquiring about the possibility of a service that's offering 3 to 6% per month doing covered call strategies, but in the same aspect also promising about 20% per week using leveraged spread trades with weekly options.
Wow. Okay, sign me up.
Oh, yeah. That old chestnut, right?
Yeah. So 3 to 6% per month is what we normally hear. 3 to 6% per month, and 3% a month, you know, all year long is 40% for the year. And what that means is, it means that you can put in $100,000 at the beginning of the year and take out $140,000 at the end of the year. That's
sure.
What that means. Okay. If you're going to say that this is your return, that's what the return is. But sadly, a lot of times with covered calls, folks are snowed by hearing, well, you know, just don't sell your stock. Keep collecting premiums. Keep doing that. We're just going to see what folks really say about that. Okay. So I've had the poll up there for a minute and a half. Let's go ahead and share the results. No one is doing 3 to 6% a month. I mean, I would think it's kicking butt and taking names to make 40% a year.
Yes.
That's 3% a month. 6% a month is 100% a year because of the compounding effect. 6% per month, if you do the math, it's 100% a year. Okay, so no one's doing that. 33% say, I'm making money, but not enough. 50% say, I have mixed emotions, I see potential, but I need to change my game. Well, we're going to talk about a game changer today. 13% lost money last year. 4% are ready to quit just to stop hemorrhaging. Well, folks, this is the baseline reading. And I'm going to make 3 bold promises in this webinar, okay? And afterwards, we're going to take another reading. We're just going to say, okay, now, given what I just showed you, would that change? Would that have changed your last 12 months if you'd have known that at the beginning? If you knew it at the beginning of September last year, would you have a different year? Okay? So I'm going to show the solution to a big problem facing buy and holders today. That's the first thing. And I'm willing to take to bet that you're going to take a look back and wish that you had thought of it sooner. Right? Number 2, I'm going to show you a riskless spread trade. So the spread traders need to tune up here. Listen to this. A riskless spread trade. It's done at a credit, but normally a credit spread involves risk, but I said it would be riskless.
Riskless, yes.
Yeah, riskless. It's possible to take income from your stock without necessarily selling it, I better slow down, or limiting the upside. And limiting the upside is what you do when you sell a covered call, right? Yeah.
Yep, cap our upside, sir.
That's kind of the opposite of cut your losers short and let your winners run it. Doing a covered call trade, I think a lot of folks are starting to find out that you're cutting your winners short. Maybe you're taking that 3% gain when your stock makes 10. Doesn't sound like the smart way to go. Okay, number 3, I'm going to show you how to ratchet up your exit point, not with a trailing stop loss order, but with something real that guarantees a better exit. And Mike has used this in recent times. Mike has used this to ratchet up his exit point to the place where finally, Mike, you got out of a trade that you've been in for, what was it, 5 months or 7 months?
It was 5 months, yeah.
5 months. You continue to ratchet. You started out with 7% of your capital at risk. Within the first month, you became bulletproof, meaning that 7% risk had disappeared.
Yes.
And then you continue to ratchet up your exit point, not with a trailing stop loss, but with options contracts in such a way that you kept guaranteeing yourself a higher and higher payout to where you finally got out with 59.8% gain.
Correct, yes.
Yeah. So that's what we're going to do is we're going to reveal that actual method that you used. We're going to show that. Is that okay with you, Mike?
No, sure.
There's enough for everyone. Okay, so that's pretty cool, I think. Now, we did our baseline reading. What kind of options trading are you currently doing, and how happy are you with your trading results? Okay, and we had some pretty good feedback from that. Now, let's talk about what the problem is. The problem is, whenever you get into any position, is that you don't know what the future holds, right? I mean, right now, folks, a lot of folks, Mike, are getting into short positions or buying puts, or essentially betting that the market is going to go down from here. But is that a guarantee?
No, we've all been wrong before. Well, I'll admit it freely. Let's not speak for everyone. I've been wrong before. I thought I've seen the point where this thing has run out of steam. There's no way this can go any higher. This market cannot go any higher. I'm going to buy puts on the indexes. Well, there goes some worthless puts 4 months later. Nothing to do, nothing to manage them, no way to really correct it and knock down that cost basis. It's just bad timing.
Exactly. And there's been times, too, when I've been long, when I've been bullish, I've thought, geez, this has got to go up. I mean, there's no way. There's no way this is not going to go up. Mike, I bought a stock that, back in 1999, I think it was, my broker called me. I was still using a full-service broker, and he said, would you believe it? There is a device that you can, put in the palm of your hand. It'll hold 60 songs. 60 songs, and it won't, it has no moving parts. He was talking about the first MP3 players.
Right.
He got into one of those first companies. Well, guess what? That first company was not Apple. that first company that I saw ended up going bankrupt. And I thought, man, this is a great idea, and I was right.
Mm-hmm.
I just wasn't right at the right time. So the problem is you just don't know the future. So welcome to the club. We've always got to deal with this far right edge. And what we're going to do, Mike, is just take a trip back in time. We're going to look at RCI. RCI is one of the stocks being traded by one of our members. And he wrote in saying, hey, how might you bulletproof this? And luckily for Ravi was his name. Luckily for Ravi, he actually had shares of the stock at a lower cost basis because he worked for the company. Okay. But what we're going to do is we're going to talk about how it might be possible for somebody without Ravi's wonderful benefit of being able to buy the stock at a low price, for them to perhaps limit risk, maybe even bulletproof the stock to where you can't get hurt. So here we are. It's March 26, 2012. And looking at this chart, Mike, what is the next thing that's going to happen?
Well, Kurt, I'm predicting that the stock, a nice little recovery there from a couple days of a pullback here. It's shown some strength. I think it's going to go back up to where it was at the top. Why not?
Yeah. You know what? You could be right.
Did you hear me flip the coin in the background?
That's right. And we don't have any certain way of knowing. Even though, yeah, that looks like a nice little pattern there. Okay. But we don't know for certain. Okay.
Mm-hmm.
But let's say we go ahead and take the plunge. All right. We're going to go ahead and get in. All right. So now what? The stock may go up. It may go down. And we don't want to feel like a chump. The thing that Ravi had been talking to us about was the fact that he wasn't sure if RCI had peaked. He was in it, and he was thinking, I don't want to feel silly. I don't want to get out now and it goes up even further. But at the same time, I don't want to hold it and see it go down and turn into a loss,
No.
which certainly was a possibility. You just don't want to feel like a chump. So, Mike, I compose this in my reverie of thinking. I compose this haiku. If I sell my stock and it keeps going higher, I will miss the boat. And the other side of that, of course, is, but if I hold it, I might give back my profits.
Right.
The stock goes down the drain. That has happened. Well, has that happened to you, where you held the stock beyond the place where it was a winner, and you said, man, it's going to just keep winning, and then you ended up with it being a loser?
Oh, yeah.
Does that happen to you, or is that just me?
No, that has happened to me. It happened to me back in the heyday of the volatile shipping companies. Dry Ships, I believe, was the one that went from about $20 up to $120, $140 over almost a year period, 8-month period, then came right back down to about $80 a month later or so, maybe less than that, and then I believe dropped down to $40.
Okay.
I think it's $5 a share right now. I'm not sure.
Oh, good Lord. So you had made money on a play with that, and then you lost money on a play with that?
Yep, I made money on the way up to 80, closed out of the position. I said it's run out of steam. I saw it go up to 120 and said, hey, this is a great play. I was doing some different positions on it, some collars and covered calls, and then sometimes just leaving the stock alone. It went up to its 140 range or whatever it was, and then it just hit the slope. And, of course, what did we do, Kurt? We looked at it, and you say, oh, well, it'll come back. I'll just average down. I'll buy more shares at 90. Let me cut my cost basis down. Oh, let me buy some more shares at 80. Let me cut that cost basis down. Uh-oh. Let me sell a call at a strike price I don't want to and buy more shares to average down. And it just still keeps going.
Yeah, that's what they call catching a falling knife. And that was not, you were not trading radioactively at that time.
No. That was before radioactive. I did know about collars, and but still I was just following the trends, following the stock suggestions. You start losing money, just average down. That works.
Wonderful wisdom. Not.
Oh yeah, Lloyd told me that Dry Ships is now at 248. So.
Oh, okay. $2.48 or $2.48?
$2.48.
Wow. Ouch. Can you imagine if you kept averaging down?
No, sir.
You don't want to. All right. So, folks, what we're doing is looking here at the chart, and I'm going to show you how to call the top. You ready for this? Look back. I mean, maybe that's disappointing. I know that some folks opened up the email today. They're looking at our promotion, and they said, you know, the title of it was "How to Call the Market Top." Well, here's how to do it. Look back. You see, it's not April 17th. It's September now. All right, and RCI peaked at this point and then started falling after that.
Mm-hmm.
Here's the top. Okay, but here's the deal. Why would you want to call the market top? You don't want to. You don't want to brag at parties. Well, maybe you do want to brag at parties. That you've got some gift that you can tell exactly where it's going to happen. No, I think essentially, really, Mike, most people just want the money, right?
Of course.
They just want the money. Well, what we're going to do is we're going to show calling the top here, but we're calling the top in retrospect. It's kind of interesting because you can get paid to do that. You can get paid to do that.
Mm-hmm.
And I'm not going to say that it works every time because it doesn't, but wouldn't it be nice that if the stock is going to have a run that you could get out at exactly the right point where you should to get the maximum profit out of the position? That would be marvelous.
Absolutely.
We're going to do that. We're going to show, we're going to show how that can be done in retrospect. Why hasn't the problem of calling the top being solved yet? Well, so far we've been only looking at two choices. Number one, fundamental analysis. This is what most of the what do you call them, the bankers out there are about. You know, Goldman Sachs and stuff like that. They'll give a price target to a stock. They'll say, we think that XYZ has a price potential of $38. Right now it's at $24, but we think it could get up as high as $38, and that's our target.
Yeah, 6 months, 6 month target, 2 month target, 1 week target. Yeah.
Right, right. And it's not giving a specific date, but it does give a specific price. Well, that would be one way to call the top. As soon as it gets to that price, you go, oh, now it's time for me to get out. Okay, so that would be one way to try and call the top. The other is technical analysis, and that's to say, well, it's going to peak on September 12th, you know.
Mm-hmm.
Today's September 11th. Tomorrow's September 12th. It's going to peak. And that would be good, too. So you just look at your calendar. Oh, it's September 12th. I better get out. And that would be your reliable way of doing it. But that's, guess what? There is no reliable way.
Right.
There aren't. Okay? Well, I'm here to tell you that there's another option. If you want to cut your losers short and let your winners run, you could build a fence around your stock with options and harness the movement, actually harness the movement that's in the stock. Now, before I show you how that could be done, I'm going to show you how it isn't done. If we have a stock and we hedge it, one way to hedge our stock is to sell a call against. Well, Mike, what's wrong with that and the saying, cut your losers short, let your winners run?
Well, this is the opposite of doing that, isn't it, Kurt? The covered call is going to act as a sorting machine over time. It's going to cut our winners short and let our losers run. And what does that mean? Well, that means the winners get called away from you for a smaller return. You don't take advantage of if you guessed right and the stock moves up. But at the same time, the losers end up staying with your account for potentially outpaced losses that are taking away your gains.
Right. Yeah. So you're kind of flip-flopping the idea. It's backwards. If you're bullish, which you would have to be if you're buying the stock, unless you're foolish. You're either foolish or bullish if you're buying the stock. All right. They say that it's safer. I don't know if I agree with this. This isn't my propaganda. This belongs to Options Express. Okay, but they say, you know, brokers will tell you that it's safer, but the reward is limited. Okay, same thing with the most spread trades. A spread trade, Mike, if you're right, you're right, and you get the maximum amount. Let's say that I sell the $45 call and buy the $50 call.
Mm-hmm.
Credit. Okay. Now, if the stock goes to $44, was I right about it staying below 45?
Yeah.
Yeah, and I get some money for that, or I get to keep the money that I took. What if the stock goes to $2? I'm really, really right. Do I make more money?
No, if it drops to $1 per share, you don't make anything more than that initial net credit you receive, the maximum potential return for the spread.
Right. Okay. So, though I do have a front-end risk that I'm familiar with, front-end risk that I know is the most that I can lose, I also am limiting how much I can make. Okay. So I got this crazy idea back in 2002 that maybe I should drag out of the mothballs the old strategy of married puts, or also called protected put. Okay, married puts, where you, if you're bullish on the stock, you buy the stock, but to hedge it, you would begin by hedging with a put position that would absolutely stop you out at a certain place if you wanted to. It doesn't. It's not like a stop order that gets exercised, regardless. This is a put option that gives me the right, not the obligation, but the right to get out at my predetermined price whenever I want to before expiration.
Mm-hmm.
Okay. The cool thing I liked about this, Mike, is that if I'm bullish on my stock, and this is a safer strategy, okay, the part I liked about it is right here, unlimited upside potential. If the stock wants to take off, why then it can take off, and
True.
we can do very, very well. So there's that. Okay, so how does that help us now? Okay, this is an old strategy, something that I pulled out of the mothballs. It's something that I call myself the champion of married puts because nobody speaks for married puts but me. At least that's the way it was in 2002. Now some folks are starting to catch on. But structuring a radioactive profit machine goes like this. Radioactive profit machine is my word for how I put together a married put. Okay? On March 26, 2012, we had RCI trading at 38.95 and the far right edge where we didn't know what was going to happen next. Now we're going to try and call the market top. Here's how we're going to go about it. First, we're going to buy the stock and we're going to set up an insurance policy. We're going to buy a put option. And we're not going to spend any money for it. That sounds weird, doesn't it?
That sounds strange, yeah.
Yeah. Okay, so here's the deal. March 26, 2012, as I said, RCI is at 38.95. So we look out several months into the future. It's July 2012, $40 put options. Now, if we buy those, it'll cost us $2.90.
Okay.
Now, when you first saw this setup, Mike, you weren't too happy with it. What did you tell me at that point?
Yeah, I shared that with our audience earlier. I said, well, I appreciate the fact that you're limiting risk, but in this case, you're still under 10%, but you're adding another 7 or 8% cost onto this underlying position. I don't see how you're going to make money unless the stock, you're not going to make a dime, Kurt, until the stock goes up above $41.95.
Okay, I want everybody to get out a pencil and paper if you haven't already got it. Okay, and I want you to write this down. $41.95, right? You see, $41.85 is the total invested amount.
Mm-hmm.
And Mike, you just said I'm not going to make a dime unless the stock gets to $41.95.
That's right, Kurt. Mm-hmm.
Okay, so I'd like to write down those figures: $41.85, cost of the position; $41.95, when I make a dime. Okay. Now, the reason I'm having everybody write that down is because we're going to come back to that. We're going to see if that's so. We're going to see if that's true, okay? Because I talked about the income methods capturing the movement of the stock,
Mm-hmm.
okay? And the truth is the stock never got to $41.95. But in the example that I'm going to show you, we made over $1. You know, we didn't make a dime. We made over $1. Okay, so here's the deal. You've got a guaranteed exit of $40. Why is that exit guaranteed, Mike?
No, when we buy the put option, Kurt, that gives us a guaranteed exit. Okay, we are guaranteed that we have the right, not the obligation, we have the right to sell our shares of stock, to force someone to buy our shares of stock, I should say, at $45. Well, 40. Yeah. $40.
Yeah. Right. If we're selling a call, we would sell somebody else the right to buy our shares.
That's correct, Kurt. Mm-hmm.
Yeah, but because we're buying a put, we're buying the privilege of being able to sell it at 40. Why does that matter? Well, if the stock goes to 30, it'll matter. If the stock goes to $25 a share, it'll matter. You know, I'll be able to get out of that position for 40 bucks. Okay, and therefore, really the only amount that's at risk here is the difference between my total invested amount and my guaranteed exit. And as a percent, it's really low. I mean, we're looking at 4.4% of this overall position.
Right.
If I have, let's say, Mike, I have $100,000 to trade. If I was to get into 500 shares of RCI and 5 put options, that would put at risk, what's 500 times that? That would be $925. That'd be less than 1% of my overall portfolio, right?
That's right.
Okay, so we're risking only 4.4% of the money we're putting into this trade. And if we diversify, which would be another layer of protection, we would keep our risk down to only 1% of our, portfolio. Well, gosh, it's hard to lose much, okay, if we're wrong. Now, I know what everybody's saying. Frankenberg, you said you're not going to pay anything for that protection, for that insurance. And
You did say that.
Yeah, but how much did I spend?
Well, you spent $290 on the put, right, Kurt?
$290. Yeah, let's go back. There it is. $290 for the put. Okay. and you might be saying, well, geez, that's great that you're keeping your risk down to 4.4%, but you spent $2.90.
Mm-hmm.
You can't make any money until the stock is at what did we say? 41.95.
41.95, sir.
Yeah. Okay. Because the cost basis is 40.85. Or 41.85, and we figure that we got to be at 41.95 before we're making a dime. Well, that's not so. But here's the deal: if I'm going to say, hey, we're not going to spend anything on the put, how is that going to happen? Well, let's finance it.
Okay.
We're going to use some creative financing, just like in real estate, right? We're going to use some creative financing. Here it is. Okay. Here we go. I'm going to sell the April $35 call. For $3.60 and simultaneously buy the April $40 call for 30 cents. Now, at this point, some of you have checked out mentally. Okay, so maybe the folks that said, I'm not trading options at all. You folks that that are spread traders, you're looking at this and you understand a spread trade. You understand a bear call spread when you see one. Okay. This is where I get paid on the front end. I get paid $3.30. But if the stock goes up above 40, I'm going to lose $5. What that really means is a risk of 170, doesn't it, Mike? Because I collect $3.30 and then I have to pay back $5.
Right.
So it's $1.70 out of pocket. Right. That's the worst that it could get. So, and this is the graph of it. Okay, I'm actually in the black, up here, and then I'm in the red if the stock goes up above $38.30. Once it starts going up above that, then I'm having to pay back for having got into this position. Okay, so I know we also say, doesn't that put even more at risk? You know what's interesting is that the married put risks money to the downside, and the bear call spread risks money to the upside. And when you put them together, you neutralize some of the risk on both sides. Both sides. That's kind of interesting. You see, taking that $3.30 credit does put $5 at risk, but on the other hand, as the stock goes up, I own the stock.
That's right.
I own the stock. Yeah. A bear call spread, you guys that do the bear call spreads and bull put spreads and, folks that are doing credit spreads out there or condors for crying out loud, you know that you get paid on the front end, but you could end up having to pay it back. But the fact that you have to pay it back is due to the fact that you don't own the stock. What if you do own the stock?
It kind of cancels that obligation, doesn't it, Kurt?
Yeah, we don't have the kind of risk that we normally would with a bear call spread. Okay? All right. So this is what Robbie's position could look like, okay, because he had a very low cost basis. But what about folks that that are getting in at today's cost basis. Mike, I would like to take a few moments and look at RCI today using the Power Options tools.
Okay.
I'll give you a few seconds to prepare that. I didn't know I was going to do this. Okay, but I'll give you a few moments to prepare that. It's going to look kind of like a check mark, though.
Right. Just want to, excuse me, just let me get out of my actual account here and get onto my webinar account, Kurt. That's all I need to do.
Okay. While you're doing that, I'll go ahead and explain some things. The reason that bear call spread can't hurt us or hurt us badly is that if we're called on to deliver the stock, well, we already own the stock.
Mm-hmm.
We're doing this in the context. This is why I claimed to be able to do a riskless spread trade.
Right.
Why is it riskless? Well, it doesn't add any risk to the position. You know, if you own stock plus a put, and you to that you add a bear call spread, you know, in the right way. You've got to do it according to the right parameters. Okay.
Mm-hmm.
If you do it the right way, you're not adding risk to the position. Okay. You already own the stock. So rather than having to buy that stock on the open market to satisfy your short call, or rather than using your upper strike call to get it at a good price, again, to satisfy your short call, you've already got it, okay? Because you've already got it on hand. Most of the risk, or all of the risk, can be gone, okay? Just depending on your cost basis. Okay, now, the $2.90 for the put option in this case is financed, right? We sold a bear call spread and collected $3.30, and that's more than the $2.90 that we're spending for the put.
Right.
Okay. All right. So it's like we've been paid 40 cents to insure our stock against loss. But let's put it another way. If the stock goes down, our insurance policy is going to kick in, and we didn't pay for it. We didn't have to pay for it. We got paid to do it.
That's right.
Kind of cool. Of course, if the stock moves sideways or a little up, all right, we may need to manage our position, but it's not going to be a bad scene. Okay, Mike, are you in the place where you could share that with RCI?
Yeah, sure. Let's go ahead. Let me make myself the presenter. I'm going to show my screen, ladies and gentlemen. How about that? Let's take this into a look here. And what we want to do is we want to say RCI, Kurt, and we're going to buy some shares of stock, correct?
Yes.
Let's just keep it 1-to-1 right now to keep things simple. What price are we going to use? We're going to use the current price, or?
Yeah, let's use current price.
Okay.
I'm taking kind of a gamble here because
all right, there's 41.
Who knows what it's going to really do? Okay,
yeah,
all right.
41.63. Now we're going to add a put. We want to go out to April here?
Let's go out to January.
All right, let's just go January. Very well. So click on January. Want to use the 40 put or the 45?
In this case, let's use the 45, and then we might also look at something else as well.
Right. All right. So let's just do that first. And then the ask is 490, bids 420. Let's be nice and say that we could get in at about 460. Why not, Kurt?
Yeah, 460 is reasonable with a limit order.
Mm-hmm.
Okay, and we're paying full price for the stock.
Wow, it's a low risk.
Yeah, so that puts 2.7% of our position at risk. Okay.
Yeah.
Now I'd like to go to a nearer term bear call spread chart. Look at that.
Let's ignore September because there's only 11 days, Kurt. Let's take a look at October, shall we?
October works.
All right.
And then let's sell the 40s and buy the 45s.
Okay, so we are going to add those into our block. We're going to sell the 40 to one contractor. It's going to take the natural bid at 150. We're going to take the natural ask for our 45, one contract as well, and that would come out to 20 cents. That's $1.30 net credit. It's going to be $7 higher than what we paid. We did pay 460. I want everyone to see that, but remember the maximum risk was only 123. So we're receiving more here than the initial at risk. Let's see what that looks like. Okay, there's your little check mark there, Kurt.
Yeah, you see, if the stock falls, we're going to keep all of the premium that we paid for. Okay, we're gonna. All the premium that we put at risk when we did the bear call spread. We're going to keep all that premium.
The 130.
Yeah, and that premium pays for some of the put option.
Mm-hmm.
and then the put option itself is a high strike put.
It's a 45. That's right. We're right here.
Yeah. Yeah. So let's try this again with another strike price. This is kind of cool. By the way, what I wanted to point out is that there's infinite upside potential. Right?
Sure.
Infinite upside potential. Okay.
But as you mentioned, Kurt, if it stays sideways or stays within this range, you know, that's a potential loss. But if it takes off as we're hoping for, maybe expecting, we're all right.
Yeah, and the maximum loss there is 6%. Later on, we'll do a poll that goes along with that 6%. Okay?
Oh, okay.
But that's our maximum loss that we can lose. If it goes down, we lose nothing.
Mm-hmm.
You see that how the graph is above the red. If your stock goes down, you lose nothing. If the stock goes up, you stand to gain something. Okay.
Yeah, I want to pause for 1 minute, Kurt, and I'm going to let you handle this question as well. But I want to address something. Dave asks, what are we looking at for commissions? But I want to clear something up, Dave. The way that we start any married put position, the first step, or any radioactive trade, excuse me, is by buying the stock and buying a put, which equals the same commissions if you were trying to enter a covered call. If you're trying to enter a bear call spread, any options trade, any spread strategy, less than what you would do if you were opening a collar or an iron condor. That's what you're starting with. This is not how we approach every position, Dave. This is not what we do with every position. Kurt is just showing you a possibility of one of the 11 income methods, this income method number 6 of what you could do. And all you've added is a spread commission to it. So essentially it'd be the same cost as maybe entering a covered call and then a week later trying to roll that covered call to a new strike price because you've got to pay a commission to buy to close the call and then pay a commission to sell the higher strike one. This would be the same commissions. It's the price of doing business. And personally, you know, my commissions are around $7.95 with maybe 50 cents added for each additional contract, and that's actually pretty high. You look at places like Trade Monster, Thinkorswim, or so forth, you're going to have a much lower commission range.
Yeah. Manhattan Beach, Interactive Brokers, you know, a lot of these guys make the transaction costs almost negligible. But Mike, let's run this up and replace the $45 put with a $40 put.
Oh, okay. You just clear that out. Let's go back, and we were in January, weren't we, Kurt?
Yes.
Okay, so 40 put at $1.25 to $1.70. Let's just keep $1.70. All right.
Yeah. Worst case scenario on everything here. We're getting filled at the ask when we buy and filled at the bid when we sell. Okay.
Okay.
Look at that.
So now there's a 4.9 risk because this cost basis here. If we bought the stock at 41.63, Kurt, and we bought the 40 put for $1.70, that would put us at a cost basis of 43.33, and we have the $40 put. So that would have been $3.30 at risk on the downside. Now by adding the go ahead.
I was going to say the maximum risk is a dollar amount here of $2.05, $205.
Mm-hmm.
Okay. And the percent-wise 4.9, but the upside potential is infinite.
That's exactly
right. So you can't possibly lose more than single-digit percents, and then we still have this unlimited upside.
Mm-hmm.
So that, what I want to point out then is that, Mike, there's more than one bear call spread that we could do between now and January.
And the other choice is, of course, you know, this is just an example, as we mentioned in regards to that the previous question that we got in. Of course, Kurt, another thing I could do is do nothing.
Right.
If my expectations were the stock might be at 45 in the next 30 days to October expiration or so, I wouldn't even put on this spread. I might leave the married put alone. Now, I could be wrong. Could not happen, but if that's my expectation, I'd leave the married put alone. If it did hit 45 somewhere into mid-October, hey, I'll evaluate an income method number 6 then. Maybe a 5, maybe a 4. Who knows? I know
more than one tool in the basket.
Yeah.
So.
And I think you're going to get to this, Kurt, but real quick, Barry just commented, of course, you can repeat the bear call after October until your married put expires, correct?
Yes, absolutely. The really exciting thing about radioactive trading is that it's versatile what kind of income methods you use or don't use.
Ooh.
But the put option is the first most important part to hedging your stock.
Kurt, can I go back real quick? Sorry, don't want to interrupt you.
I took your screen from you.
No, that was fine, but I just want to go back real quick just to address a question, then I'll give it right back to you, okay?
Okay.
we had a question come in, and it was Mike. Mike asks, what happens if the stock goes to 50? Don't we lose the stock? Yeah, but what else do we have? Stock. Let's say the stock was here at October expiration. Okay, we have an obligation to deliver our shares of stock at 40. We sold a 40 call. But we also bought a 45 call. Now, depending on your broker, Mike, your broker might look at this and say, oh, the stock's at 50. We're going to exercise his 45 call to buy shares of stock at 45 and sell them at 40. So that's your 5-point loss. And you did collect $1.30 up front, so you've got a loss of $3.70. But in order for that to happen, your stock, which you still own, has moved up $8.37. So you gave up $3.70 to make $8.30.
That's okay. And something to look at there is that $45 call option. It's like you've been paid to own it.
That's right.
Because it was a part of the spare call spread. It's like you've been paid to own a $45 call. So if the stock's at 50, yeah, you might deliver your shares of stock at 40, which, by the way, you got it less than 40. Wasn't it $38.95?
Yes. Your position was at $38.95. That's right, sir.
Yeah. And then we end up holding a $45 call that is, paid for. It's not like we had to buy the call.
And I'm going to interrupt you one more time, or just go take one last question, then I'll let you move on. I apologize, Kurt, but this question when it comes up is important for me to handle because I don't want someone calling me up a week from now and saying, "Hey, I followed what I saw in the webinar without buying the blueprint, and I immediately traded a spread using weekly options. Now my position's underwater. What do I do?" I don't want that phone call. I get that phone call. The question came in is, would you recommend weekly options to accelerate profit potential instead of monthly? Yes, if it matches the rules in the blueprint. See, this isn't the trade that we're saying you open a married put and you do this right away. That's not what we're saying. There are 11 different income methods, okay, but you want to follow the rules in the blueprint is when to apply them. Can you use weekly options? Yes. Can you force yourself into a bad position if you try to trade a weekly option too soon just for the sake of doing an income method? In other words, are there ways that you can put yourself in a bad position where you actually increase your risk one direction or the other if you try to force the position too soon? Absolutely. You want to avoid that. You got to follow the rules in the blueprint to know that, okay, now that this situation has happened, let me evaluate an income method number 6 trade or an income method number 5 trade. You can use weekly options. Kurt has done that before. But when the stock...
I've never been real happy with it, to be honest. I've never been real happy with weekly options with the reduction profit machine.
All right. Okay, Kurt, so let me give you the screen back, and let's move forward here. And I'll handle some of those other questions. And, yeah, you're all set. Just show your screen. We're good to go, sir.
Good. Okay. So back to where we were. We took $3.30 credit in order to pay for our put option. Okay. But we also own the stock. So it's like we've been paid 40 cents to ensure our stock against loss. Of course, if the stock goes up, then we sometimes have a problem. Dang. Here's what happens. On April 20th, expiration Friday, remember we had a short $35 call, right, and a long $40 call. So now she's at $39.66. That's about as bad as it can get for our bear call spread, isn't it?
That's right.
Yeah. So let's. What I wanted to do is I intentionally chose this example so that I could show how to deal with that. Okay. So we buy to close our April $35 call at $4.66. Okay. Or we simply allow it to be assigned and we buy the stock at $39.66 after selling it for $35. So it's the same amount out. Okay, $4.66 out. But here's the deal. It's April 20th, but here we are looking at historical prices for option contracts for May on that day. You know, there's quite a big spread here, $4.40 to $5. Big spread here, 55 cents to 90 cents. But even if we got filled at the bid and at the ask, as much to the bad as possible, okay, and we rolled by doing another bear call spread, we would collect another $3.50, right?
Right.
So far we've collected $3.30 for the first bear call spread. We had to manage it, but then we also collected another $3.50. Okay, so how that goes. One thing a lot of folks don't get is that you can often roll a bear call spread at a credit, or if you don't take a credit, it can still be advantageous to close and reopen, and that's what we're showing here. Closing and reopening it, rather than delivering our stock at $35 a share. We've closed and reopened instead of an April bear call spread. Now it's a May bear call spread. Okay. Now, meanwhile, the stock going up or down in this context guarantees a gain because of how much we've collected. Okay. Now, on May 18th, expiration Friday, guess what happened? The stock did close slightly in the money, but not a lot. It was at $35.21, and so for 21 cents, we can end our obligation, or we can just allow it to be assigned. Okay? So here's what's happened so far, and I'm only showing one income method, but we're going to show the combination of another income method here in a moment.
Okay.
Let's revisit everything, okay? All the options. We have taken a credit for doing the April bear call spread, right?
Right.
And we took a credit for doing the May bear call spread. So now we have a total in of $6.80. Now, on the other side of the options, we have paid $2.90 for the July $40 put. We paid $4.66 to keep the stock in April, and paid 21 cents to keep it in May. So our total out is $7.77. So with a total in premium collected of $6.80 and total out of $7.77, here's what I still have. I still have the stock, right? And I still have a put option, but my total cost basis for all the options here is 97 cents. Here's the deal. The April call spread, the May call spread are already over with because of our management of them, but the July put option is still in place. So let's see what Just Income Method 6 has done for us. All right, on March 26th, 2012, the price of RCI was $38.95. And after all the smoke is cleared from buying the put and doing the income methods, we have a total cost basis for our put left, because the income methods are closed, but we got a total cost basis for our put left of 97 cents. So we've got a total invested amount that we've put in of $39.92, and we've got stock, and we've also got a put option that guarantees that we're going to get $40 back. Now, the stock could go above $40, right?
That's right.
Yeah, it can still go above $40, but what it can't do is it can't lose us any money. We've got a negative amount at risk. We'll see that. We've got $39.92 invested, but $40 guaranteed back at least. You see where that's a bulletproof move there, Mike?
Absolutely.
Right.
We have a negative at risk, right? Negative at risk means guaranteed profit.
Right. Now, the 8 cents of guaranteed profit is nothing to write home about. Okay. Hey, I made 8 cents. How much did you invest? $39.92. Well, okay. But it's not shabby when the stock's at $35.21. The stock right now is at $35.21. Well, not right now, but at May expiration. Okay. The stock's at $35.21, and so therefore, we've got a choice. Either we could have just used stock, and we would have taken a $3.74 hit, or we've got a guaranteed 8 cents plus we got some time left before expiration.
Right.
Okay, so before the stock that was at $38.95 goes to $3.21, that would have been a $3.74 loss. But now, with what we've shown so far, we have a guaranteed small gain. Okay? Now, I haven't shown the secret sauce yet, Mike. Remember we said we were going to call the market top, right?
Yes, we did.
Okay. Here's the secret sauce. We've only shown one income method, but during this time we might also have done another. Now, income method number 4 is an income method that we do not trying to predict the future, but doing something in light of what has already happened. So when the stock behaves a certain way, that's when you do this income method. And after it has behaved a certain way, guess what? You change your overall position. This is called income method number 4. And here's the deal. There was 2 times where RCI shares hit $40.58 during the time frame that we were talking about. Okay, it hit April 2nd, and then again on April 17th. But here's the indicator. Whenever your stock goes above the put option's strike price, remember the strike price is 40.
Right.
Whenever, whenever the put option goes above that, it's a candidate for income method 4. It doesn't mean you have to do it, but it's a candidate for it. Okay. And guys like you, Mike, you like to use income method 4.
I do. I know most people don't like to because they don't want to pay that debit, but I like the payoff, and I'm happy with that.
Yeah. What folks have trouble wrapping their heads around is that it's a debit, but it has a guaranteed payoff later.
Yes.
So here's the deal. RCI shares are at $40.58. Okay. So what we can do is we can do something with that $40 put. Now remember, we had picked it up for $2.90. It looks like we've had a loss, doesn't it?
I can see that.
Yeah, it looks like a loss, but in this context it isn't, because in order for the put to go down, the stock had to go up, and I still own both. Okay. What I'm going to do is take this diminished value of this put, and I'm going to set it against the also diminished value of this put. I'm going to sell this $40 put and buy this $45 put. Now, I've got to spend $370 to do that. Well, why would I do that? Well, it guarantees a $5 higher payout, right? Yes or no? I mean,
yes, we get $5 guaranteed exit now, so it's just like generating a credit, in my opinion, of $1.30. It's not realized right now, but I am paying $370 to guarantee $5 back out later.
Right. And if the stock keeps going up, well, the stock keeps going up. That's great. You know, we still own it. We can do income method 4 again. You've done it repetitively to lock in higher and higher. Why not continue to do that? We could. Okay. But because I wanted a simple example today, we're going to use this. We do income method once. Income method number 4 once. Okay. So here it is, spending $370 for a $5 higher payout. It's like collecting $130. Now, a lot of folks out there in our webinar land are saying, you want to add $370 to the cost basis? How is that a benefit? Well, let's go ahead and add it. Okay, we've got the $38.95 for the stock, the 97 cents for the original put. Okay. Invested is $39.92. We've got a guaranteed return of 8 cents. Not so cool. Okay, but if we do all those same things and we add our $370, okay, now our new total invested amount is $43.62, but it's not a $40 put anymore. It's a $50 put. I like the $50 put because that guarantees me $1.38 back. Better? Better. Okay. Now, I want you to see something. Mike, the second time that we managed income method number 6, we spent 21 cents to close it, right?
Yeah, the stock was at $35.21, right? And you closed it right at expiration, right around expiration day, correct?
Right. If we didn't spend that, then our guaranteed amount back would be not $1.38, but $1.59. Right?
That's right.
So if we just allow ourselves to get assigned, then we capture $1.59. Okay, and that's what I wanted everybody to see, because I talked about what do you call it? I talked about calling the market top. So here's the deal. In truth, if you had just the stock and a crystal ball, and you knew that the stock was going to peak on April 17th at $40.68, you could get in at $38.95 on March 26th. Remember our far right edge, right? We get in on March 26th, and then we get out on April 17th, and we make $1.63, or 4.2%. Okay, when you set the 163 against the 38.95, that's 4.2%. Okay, or here's what we did with radioactive training. Okay, this didn't require a crystal ball. We got into the stock, but we also bought a put option, and we financed the put option with our bear call spread. So we ended up actually getting paid 40 cents. Takes 40 cents off the cost basis, right?
Mm-hmm.
Okay.
Yeah.
Instead of $38.95, we spent $38.55, and then we close it on May 18th for $40.14. Okay. We end up exercising our put. Okay, and I'm sorry, not exercising our put. We end up getting called out, and then selling our put.
Mm-hmm.
And that's where we would be on May expiration. Now the profit's $1.59, okay, but instead of $1.63, big whoop, right? Here's $1.63, okay, stock only. $1.59 if it's stock plus put, but remember our cost basis isn't $38.95, it's $38.55. So, Mike, before we go on, I want us to break out our papers where we recorded the price. When we buy the stock at $38.95, we buy the put at $2.90. What was our price?
Oh, well, our cost basis, Kurt, stock plus put, was $41.85.
And most of my critics say you can't make any money until what?
Well, we couldn't make
a
dime unless the stock was trading at $41.95.
Okay, and yet the stock never even reached that, did it?
No.
It got to $40.85 was the highest, or $40.68 or something like that. It was 40 and change. Maybe we could go back a few slides. It went to $40.68. Never got to $41.95. And yet we milked every last bit of the movement out of this play. Is that cool or what?
Very cool.
Yeah. You know, and so what if we had to look back in hindsight to see what the top was? Okay, look at this tumble. Okay, as the stock tumbles, see, now we get to exercise our put, and we're out of there. Okay, but that's what this is all about. Now, as far as the income methods, when most folks think about income methods, they think about covered calls because that's all we have heard about, taking a premium. But Mike, did you see how we did income method 6? Didn't introduce risk to the position, and we didn't limit the upside. Okay, and there's actually a number of ways to do this. Income method 6 is just a teaser.
Right.
Income method 4 is a teaser. We got 11 different ways. So that's something I wanted to make clear. Now, let's go ahead and before I explain how it works, okay, let's do a poll. We asked everybody, hey, are you happy with your trading results? How happy are you? And, absolutely, very much, yes. Nobody said. Okay. Pretty good, doing all right, making money, but not enough. 33% said. And then the rest of our audience was distributed among the last 3 answers, all varying degrees of, well, no, I'm not happy. Because the question was, are you happy with your trading results? Nobody,
right.
Nobody after the second category, answered, I'm happy. Okay, so let's hide that. Let's just talk about the risk. If you limited risk like what I showed, keeping your risk down to 6% or less per trade, or 1% of your portfolio, would you have been happier with your trading last year? Keep in mind that any losses that you did take, for example, if you took a 20% loss, if you could reduce it to 6%, that would mean that you'd have more to put into another trade that was a winner.
That's right.
Okay, so I'm letting that list populate right now, and it's looking, pretty much like I thought it would. And you can answer. I think on this you can answer more than one. Maybe I'm wrong about that. I think I am wrong about that. Maybe you can't answer more than one. Okay, I'm gonna leave that up for another few seconds. Oh, look at that, round numbers. Oh, that's gone. Okay, 3, 2, 1, and I'm going to close it. 7% said I lost overall last year, but I would have won if I had done that. And 50% says, I might still have lost, but I would have lost much less. So are we in a better position?
Absolutely. Mm-hmm.
Yeah, but this is the one that really gets me, Mike. 43% saying, I would have been one that said, I'm very happy with my trading. And how many said that before? 0.
0.
Right?
That's right.
0% said, I am very happy with my trading. And now 43% would be saying that. And 50%, you know, if they did lose, they would have lost much less, right? 10%
Right.
overall, they did lose last year, but they would have won, and that's a big difference. Okay, cool. Let me ask you this. What do you think of spread trades that take income but risk nothing if they go against and still leave the upside open? And how are we doing on time, Mike? Do I have time to
It's
explain
10 after. It's 10 after, Kurt.
Oh, it's 10 after. Boy, I don't know if I can. Well, maybe I could give the Cliff Notes version. Okay, let me go ahead and we'll cut this poll short, okay? So everybody that's on the polls, real responsive now. Pick one of those or don't pick something, you know, but do whatever you're going to do in the next 5 seconds. 3, 2, 1, and close. Okay. Get a tie here. 36% say, hey, that beats the shiitake mushrooms out of cover calls. And 36% says, hey, can I do that on my IRA? Yes, you can. 29% say, whoa, I didn't know you could do that. You got any more? Yes, we do. 10 more. Okay, so cool. All right, so Mike, let me give just the Cliff Notes version, okay? The thing is, we buy a put option that's in the money. And the reason we buy a put option that's in the money is because the time value component of it is cheaper there, okay? But when that call or put goes to at the money, those prices swell at the money. And
that's
so that's
right.
how income method number 4 worked, okay?
Mm-hmm.
Where you know, we had bought the put option, right? And then the stock went up, and so the put actually comes down in price, but then again, so do all the others. But something that doesn't go down is the time value component. In fact, the time value component swelled. It got bigger than it had been. Now, since you don't have any loss in the intrinsic part, because that loss in the intrinsic part of the put is covered by your gain in the stock, there's no net loss there. And so using this ATM bell curve, I like to say this, instead of timing trades, trade time.
Mm-hmm.
You know, we use the advantageous pricing of the puts, and was able to reduce the break-even. When you reduce the break-even, you know, that's the difference between what you spent, right, and where you can get out.
Right.
Okay, there's the break-even. Okay, we can reduce that break-even by doing the income methods. And it's possible to reduce that break-even to even less than 0. And that's what happened at the end of this RPM that I showed, okay, where the payout was higher than the stock was trading. Remember, we had a $40 put option, right? And when the stock is trading at $35.21, but that put is paid for, you haven't lost a darn thing. Kind of cool. Okay. So what had been the problem? The problem was, well, you know, we could purchase our stock at $38.95 and have no guarantees.
Mm-hmm.
All right. But instead, what's possible is you can build a fence around the stock using options and even get paid, possibly, to buy an insurance policy.
Mm-hmm.
So what's different now? On the way up, income method number 4 locked in a better price, and on the way down, income method number 6 cashed us out. Okay, and so we captured the movement up and down of the stock without him putting more than 4.4% at risk. Kind of cool. Okay, here's the RCI shares at $38.95. There's the puts. There's the total invested. Now, remember, most folks would look at this and say, you can't make any money until the stock gets at $41.85. But the stock hit a high of $40.68, and we captured $1.59. Interesting. Interesting. Okay? So, there's the deal. There's the deal. Now, so what? A lot of folks will say, so what? You can lock in a price. You can even bulletproof your stock. What's the big deal? Well, the big deal is that upside potential that we talked about, which is infinite. I did this one time in a stock that made it bulletproof, and then it ended up returning me 30% over a 2-month period. It was while I was playing income method number 6. Mike, you did this in a 5-month period. You got into a stock that paid you back 59.8%?
Yes.
Yeah. Now, that's not you buying a long call option and selling it for a 59% gain. That's you buying 300 shares of stock.
Right.
Protecting it with 3 put options, doing multiples of income methods, and then getting out with a 59.8% gain on your whole thing. 59.8 on not just the options, but the stock and the options.
Right.
Combined, that combined cost basis. So, so that's what's available. That's what's possible. Does it happen every time? No. But if it does happen sometimes, and the rest of the time you're losing 4, 5, 6% when you're wrong, well, that's still a happy deal. Okay, and so that's what we're about. Okay, Mike, do we have any other questions?
Yeah.
We're right where we should be stopping, but I'd be happy to field a couple of questions before we let everybody go.
Yeah, this one's a tricky one. Tim asks, it's not a tricky one, it's just a confusion part. Tim asks, if you use a married put setup, do you count the margin requirement against your maximum capital risk even though it's protected? Tim, we're not using margin at all. When I buy the stock and I buy the put, I'm paying the full amount out. I'm not using margin to buy the stock, and I'm not selling a put. I'm buying a put to guarantee that exit price. So I have all my cash out front. There is no margin requirement for that position.
Yeah. Now, let me further answer that.
Oh, of course.
after
I knew you wanted to.
Yeah. After April 2nd, 2007, new margin rules were applied, and you can you need to check with your broker if you qualify. Okay.
And yeah, it's referred to as portfolio margin, I believe.
Yes. It's possible for you to borrow as much of your portfolio as is protected. So, for example, say you have a stock with a cost basis of $35, and you get a $40 put option with a cost basis of $5. You would have to get those at different times, or you'd have to reduce the cost basis of one or the other by way of the income methods like we showed. But what have we got now? Net cost basis of $40, and we're guaranteed $40 back. Guess what you can borrow? Up to $4,000.
That's right.
You can borrow that on your margin. Now, I do not do that to get into a position. But, you know what's kind of cool is, let's say that you had some other deal or some other reason why you needed cash. Say you can get a discount on your daughter's braces if you pay cash up front. Say you come across a real estate deal that just needs a little bit of cash. You could actually, if you have a bulletproofed position, you have a bulletproof stock, you could actually borrow the money that's in that and pay only the margin interest, and that's really all that's at risk because you bulletproof yourself. Now, I call it the two-step because guess what? If the stock continues to go up, you still are in that position. And if the stock goes down, so what? You exercise your put and you're out, and you pay off your loan. So that's one of the creative types of things that's available when you use a put option to protect your stock, and especially if that put option is has made your stock bulletproof.
Okay. Can this be
Other
done?
questions?
Yeah. Can this be done in an IRA? Absolutely. I actually trade in a restricted account. DW asked that. I actually trade in a restricted account at Fidelity. Also have accounts at Options Express. In my Fidelity accounts, I'm able to do these RPM techniques. With the exception, I can't do the full version of income method number 5 or income method number 8. I can't apply to do income method number 7, but I can essentially do every income method except for the full version of 5 and full version of 8. And this is a question that you might want to handle, Kurt. I kind of answered this. Customers looking at your trade simulator tool numbers and your track record, kind of where you show that over time, when you're right 49% of the time, wrong 51% of the time. When you're right, you make 6.4%, and when you're wrong, you lose about 4% or so. Now, the customer said, well, so is that what I should expect, 6% per month? No, 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 that's not what it's saying at all. We don't like to make any promises of what you can make. Each investor is different. Kurt and I trade different positions. We have different profits that we make. That 6% average gain that's shown on the trade simulator tool on radioactivetrading.com is reflecting Kurt's closed positions. Some of those positions might have been open for a 3 or 4 month period. Some of them might have been open for 2 weeks. It all depends on following the rules in the blueprint. We don't like to say the average return that one can expect, but I can tell you this. You've seen promises out there that promise, Kurt, what? 3.6 or 3 to 6% per month trading covered calls. Well, what they don't tell you is that, hey, you're still risking 97 to 94% of your investment on the downside. We know that even in the worst case scenario, we're still keeping 94, 95, 96% of our marbles.
Yeah, it's just flipping that whole thing upside down. Instead of, I determined long ago I was not going to make any claims about what you can make monthly. And the person that, I'll go ahead and just say who the person was that made that popular. It was Wade Cook back in the 90s. He made it popular to expect a monthly return and to pack his seminars with people by saying, hey, you know, we can take your nest egg and we can start making 3 to 6% per month on it. And, you know, it's just not sustainable. So I determined that I was not going to ever do that, make any kind of income claims. I tell you what I can tell you, how much you can lose. So if you set up an RPM that risks less than 6%, like the one we showed today risks 4.4%, guess what? That's how much you can risk. And that's a claim I can stand by no matter what. On the other hand, you know, in situations like Mike, your trade with silver wheat or with PXP, you know.
No, PXP, Plains Exploration, right. Mm-hmm.
Yeah, you made like 30% on that. You know, I made 30% on Marvel, made 40% on Priceline.
You did GMCR in 8 days. You had a 15.8% profit. I can't remember what it was.
Yeah, 15% and change. Yeah, I think it's 15.8. But the point is that rather than, you know, I want to be different. Rather than posting, you know, the big gains and so forth and making it seem like that's commonplace, I want everyone to understand that that's not commonplace for anyone.
Oh.
But that it happens. And it happens best when you haven't lost too much on your other stuff.
Mm-hmm. And what's the other? Well, here's the other trade. What is the other trade we like to share about numerically that we showed during the advanced income methods webinar that's available if you pick up the home study kit, Kurt? My very first radioactive trade. I was in the position for about 6 or 7 months, and I made 1.8%. Woo-hoo! Fantastic.
Yeah, except the stock went down 70% or something.
75%, and I was long stock the whole time. If I had managed that as a standard covered call of what's taught, I would have been down 56%, 57% over that same time period doing covered calls. If I just had the stock, it would have been down 75%. I made 1.8% with the stock being down 75%.
Yeah, to be able to say that you made a profit on a stock that you were long on that went down 75%, I think is more of a testimony.
That's right.
Than the outsized gains. So cool, man. All right, Mike. I think we're going to wrap her up. I'm pleased with the questions that we got and so forth. I put up on the screen how to get a free 2-week trial of Power Options, and I suppose I should also tell folks where to get the blueprint if they want it. If you go to radioactivetrading.com. The blueprint and the home study kit are available with a 100% money-back guarantee. And let me go ahead and send that to everybody. I'm doing this one-handed. There we go. Okay, I think that's a clickable link that I sent to everyone. And if not, you can copy and paste it and put it in your browser. Okay. Mike, I think we're there. Are we there?
I think we're there, yes. I'm just going quickly through that. Okay. All right. I think we're good, Kurt. Sorry. Oh.
Rocket. Not at all. All All right, so we'll see you out there, folks. Thanks for coming. Happy trading, and hope to see you on Thursday. All right, back to you then.
Sounds good.
Bye.